So, welcome everyone. So, this is the third chapter 3 of our webinar, and it's about the debt markets that we are covering. And today, the focus of the topic is how the RBI rate hike would impact the market, and what should an investor do in the forthcoming times. So that's our topic, and we have with us Satyakam, who has a total of 15 years of experience, and we would like to learn from his experience and understand the markets. Thanks. Satyam, over to you.
Thanks, Vikas. So can we go to the presentation?
Yeah, I'll just open it.
Yes.
Yeah.
Thanks, Vikas. Good morning to all of you. And it's a lazy Saturday morning. We had the second shower monsoon in Bombay also. So monsoon looking pretty well right now. So today in the given presentation, I will take us through the what has been happening in bond markets, local as well as global. And we will try to focus more on local bond markets because RBI MPC meeting just happened this week on 8th of June, and see how it affects the local bond market yields. And if you have any questions, you can ask them at the end of the presentation. So let's move to the next slide. So as all of you are aware that since 24th of Feb, when the Russian-Ukraine crisis has started, there has been a sea change in what you call as, let's say, supply side issues across the world, whether it is fertilizers, whether it is crude, whether it is natural gas, whether it is food grains. Because, I mean, if you look at the pre-24th Feb era, Russia as well as Ukraine were major producer of food grains. Russia, as all of us are aware, is almost 10% of the total crude production, almost like 25-30% of natural gas production. And Russia was very closely integrated with Europe in terms of supply of crude and coal as well as natural gas. So almost 35% of European crude was coming from Russia because of geographical proximity. In natural gas, almost 45%. In coal, almost 25%. Now, all of that changed post the 24th Feb event. As most of you are aware that there has been a series of sanctions on Russia, almost 6-7 rounds of sanctions from EU on Russia. And right now, my guess is that if the pre-event Russian crude production was around, let's say, 10 MBPD, right now it's somewhere around 7.5 MBPD kind of figure. And these sanctions are not going to go away very soon. Considering the political mood in European Union as well as US, these sanctions likely to continue for some time. So my sense is that whatever dislocations we are seeing in price across all asset classes, whether it is fixed income, equity, all this is correlated to this event. And this event is not exactly a political event, it's an economic event, considering the kind of linkages both Russia and Ukraine had with the global supply chain. So it's going to play out in a very long-term, medium-term kind of scenario. It's not a short-term event. Obviously, all of us are aware that we are facing unusual heat waves across world right now, especially in India also, because of which the wheat food grain production was impacted. And we are seeing surges in price of food, energy, industrial items, you name it. I mean, except commodities like metals like copper, steel, zinc, which had perhaps corrected in the last 2 months because of the COVID lockdown in China. Everything else has been rising in a consistent way, whether it is wheat, cotton, soybean, soya oil, palm oil. And one of the interesting things which is happening globally is right now that this trend of globalization, according to my understanding, is completely extinct now. Each country is trying to save its own resources. Each country is trying to, let's say, incentivize the imports and de-incentivize the exports so that more material is available locally and there is no shortage of items, and then there is no increase in prices. So we have seen countries ranging from India, from Indonesia, even for that matter, Eurozone also, putting in local controls on various kinds of items. So in India, we have seen what we call as export ban on wheat. In Indonesia, we had seen an export ban on soya oil, palm oil in the month of April. Fortunately, it has been lifted off. So all these things are pointing out that each country is trying to have its own policies on resources. Now, if that is the trend, then the globalization is actually pretty extinct right now. And if that is the view, then the kind of disinflation which was because of globalization since 2002, 2020, 2018, that can be considered to be out of the window right now. So there is a natural tendency for inflation to go up because of the inefficiencies created because there's a lack of globalization. So that is one major theme which is playing out right now across all products, all markets. Now, yesterday, a very important data came out for US CPI for the month of May. Market estimates were around 8.3% on the headline number. My own estimate was around 8.5, but the actual number came at 8.6%. And that's almost like a 40-year high number. And these, I might guess on the next month number for June, US CPI is around 8.7%. And for the month of July, it should be around 8.9%. I mean, if you look at the gasoline prices in US right now, it's somewhere around $5 per what you call is $5 almost in terms of we have liter here. In US, it is there is a different concept there. So the price, what I'm trying to say here is the price there of gasoline is almost 40% higher than last year. Now, if that is a trend, then Fed, I think Fed is going to be in a very difficult spot in this FOMC meeting on 16th of June. That is Wednesday night. My sense is that Mr. Powell in the last FOMC meeting tried to sugarcoat that any kind of action, Fed rate action is going to be on a let's say not going to be a 75 bips kind of hike. He tried to take off that option from the table. But considering the yesterday numbers, I'm pretty sure that a 75 bips hike is quite right now priced in by the market either in June or July. And September, many Fed speakers were talking about was going to be either a pause or only a 25 bips hike. Now the markets have started pricing in a 50 bips hike in September as well. So my sense is that by end of 2022, we should be 3 to 3.25% on the Fed overnight rates, which is quite high from the current numbers. We are right now at 0.8750. These rates would obviously be the highest since 2008. And my sense is that we don't know where we are headed right now. Okay. So maybe for the entire CY22, the core PC number should be around 4.5, 4.6%. But I don't see this number coming down drastically next calendar year, except perhaps because of base effect. But if the Fed mandate is symmetric plus minus 2%, then I think it's not before 2024 that you would see the numbers going below that 2% or around that 2%. So we are in a very, let's say, decent rate hike cycle in US Fed right now, which should obviously impact all kinds of markets. Yesterday, we have seen a major move in risk assets, whether it is equities, whether it is bond markets. So 2-year US Treasury yield is now trading at 3.06%. Now, I just want to give one data here that in 2018, when the core PC was around 2%, then 2-year US Treasury yield used to be trading at 3%. Now the core PC is around 4.5% and we are only at 3.05. So there's a big scope for yields to go up from here. And if 10-year USD crosses 3.2% on a weekly level basis, then my sense is that we are headed sooner or later towards 4% with a stop around somewhere around 2.7%, 2.75%. So my sense is that global markets are right now seeing a huge amount of uptick in yields. If you look at ECB meeting also, ECB was perhaps one of the dovish central banks across the world, except Bank of Japan. Now they have also started talking about rate hikes of almost 75 bips. They have talked about it themselves. So the market is pricing around 150 bips of rate hike in CY22. So everywhere you are seeing a series of rate hike. Okay, so that's a trend which is globally playing out.
So, Satyakam, so it's pretty evident that inflation is on the rise, and the central banks across the world are trying to tame this beast. And to tame this, they are using the monetary policy tool as the interest rate. And the interest rate cycle has like changed from the easy money. It is going to increase, and we expect to at least increase in the US case of US almost 1.5, almost 2% rise in next year, say 6 to 7 months. So, in case of India, yesterday we saw the RBI has also increased the 50 basis points the repo rate. But one question that comes to the mind, initially you have talked about the supply chain breakages because of the Russia and Ukraine war. But how effective is this rate hike? Won't, because it's a supply side issue. Can it be controlled only by what the monetary policy action?
Uh, Theoretically speaking, a monetary policy action is not effective in controlling supply side actions. You're right in that. Practically speaking, so let's say in any price rise, there are two components. One is the natural demand led, let's say, price rise. The other is because of the supply side. So monetary policy is trying to take some action which might try to control or induce some slowdown in the demand, aggregate demand. And that is what it is trying to do right now. Obviously, it is not going to be as effective in controlling the supply side, but at least on the opening up of economies, at least in terms of service inflation, which is likely to rise up very much significantly from here as the economies are opening up, at least there the central bank's monetary policy actions will be able to reduce some amount of aggregate demand. And that's why all these central bankers are going through this route. I mean, all of us are aware that predominantly these are because of supply side effects. But at some point of time, you have to take that risk and walk that line of trying to reduce the aggregate demand. So that's my sense.
Okay, so I understand the inflation is increasing and the monetary policy, the rates are going to increase in near future, and this rate hike cycle has begun. So how does it impact individual investor? Like why should he be worried? He will be getting more return on the savings account or in FD or in any of the bond market. Why should it worry him? And moreover, these steps are in its favor to control the inflation. So what would be the impact on a individual investor?
So look, let's say if I'm a normal investor, I have got my savings across multiple assets, let's say equities, real estate, gold, and let's say some amount of investments in debt mutual funds. So as the interest rate goes up, obviously the risk assets suffer first of all. And considering the elevated inflation in equities, I think equity is a strict no-no for me, even at these levels. So that's where I would be very, let's say, skeptical about my investments. I think people should move out of equities for some time because there's a huge correction likely to happen there sooner or later. And in terms of fixed income, what happens is that obviously your earlier investments in mutual funds or specific bond investments might suffer certain mark-to-market losses. But if you are holding till maturity, those instruments, your yield or your income is fixed. Post-tax, it is fixed, right? But yes, it gives you an opportunity in terms of what else can you do if you're trying to move out your money from equities or let's say a real estate sale capital into bonds. So I think we should utilize this current high yield information environment to start or initiating some investments in bonds, corporate bonds, specifically AA bonds where the spreads are quite elevated. And there are certain parts of the yield curve where people can definitely look in terms of very decent return, even after post-tax, even after considering whatever is happening around us. And one of the things which we need to figure out in case of India, the local markets, is that whether this rate hike cycle is a long rate hike cycle or is it a shallow rate hike cycle. So unlike US, where the rate hike cycle is quite long, I expect it to go to 3.5%. In case of India, we don't have the luxury of very strong growth numbers, and we might not see a very long rate hike cycle. So for me, the terminal repo rate for India is, let's say, 5.65, 5.75, and that should be done by December 2022. But beyond that, what is the case? Now, if you look at RBI's projections for GDP for Q3 and Q4, it's 4%, 4.1%. Now, if GDP numbers are so weak, and we are expecting in the next year, FY24 onwards, the GDP should be around 5 to 5.5%. I don't think our economy has the luxury of too much rate hikes also, right? And my sense is that FY24 CPI number should be averaging around 5.25, 5.5, which should give some breather to the RBI to take a stop on the rate hikes. So if we are believing in the view that the current rate hike cycle, at least in India, is not a long-term rate hike cycle, then the rise in yields gives us an attractive opportunity to invest into certain parts of the bonds. whether it is AA bonds, whether it is AAA rated bonds, or whether it is target linked index ETFs. So there are opportunities out there. If your view is that perhaps beyond the next 50-75 bips hike in repo rate in India, there would be a status quo.
So just to paraphrase in a simpler manner, so what you're saying is in India, the rate hike cycle would be completed by December. If that is the view, then one should look at investing in the shorter tenor papers, which is AA and above. So, what should a person do? Should he take out all the money out of the equities and hold on till December so that the rates are at the peak and then go in the market, or they should start investing small portions into such debt papers? So, what would be your view? What would you do in such a case?
Yeah. So, Vikas, I will go through that question. Can we come to the next slide, and then we can come to that exactly that question is covered in the next slide.
Okay.
So these are what has been happened. This is what has been happening in terms of liquidity. I'll just try to cover the theoretical part, and then we'll come to the application part. So if you look at the net liquidity surplus, that has reduced significantly. Right now, it's around system liquidity is 3.3 lakh crores, and the reduction in liquidity has started from 2021. So my sense is that when the governor says that it's a multi-year, let's say, reduction in liquidity, when the time comes, he would say that we have been reducing liquidity from 2021 onwards, and hence this would be the end of the liquidity withdrawal. Can you go to the next slide, please? Now, so this is your question, right? What investors can consider for doing in their portfolios? Now, my sense is that if, first of all, if I have visibility on my funds requirement and liquidity requirements, and if let's say if I come out of equity allocation, if I come out of real asset allocation, then maybe I need to target, let's say, ETF bonds maturing in 5 years or 10 years, depending upon the risk appetite. Again, this investment needs to be done in 2 or 3 tranches, 3 or 4 tranches. It should not be done in lump sum till December 2022, because you can't time the market, right? So you have to invest, let's say, if you are going to invest, let's say, 100 rupees into target linked ETF bonds, which are typical PSU bonds or GSEC bonds, which is 5 years, 6 years, 7-year maturity. Then you should start investing every 100, let's say, rupees every 2 months till December 2022, so that you are able to capture the entire move, right? The second part is, I think.
Sorry to interrupt you. So when you say investment in target ETF bonds, the keyword is target out here. If I do it in normal ETF bonds, will there be an MTM impact?
No. So what happens is, let's say, like AMCs like Edelweiss, they have this 5-year SDL index bonds. So it's a held till maturity bond, right? So 5-year SDL, let's say 4-year GSX is, let's say, trading around 7.25%, 4-year SDL, let's say 7.45, 7.50%. So 7.5% is my YTM if I hold it in maturity, right? So beyond the expense ratio of whatever 0.05, 0.5%, not 0.1%, 7.4% is net, and post tax it comes around, let's say, 5.6, 5.75%, which is a pretty decent return if I'm looking for a longer horizon, safe horizon.
Yeah, but again, that would be lower than my inflation, because my inflation is around 8%. And even if I invest in such bonds, maybe there's a capital protection because they're highly rated and the PSU bonds. But again, I'll be on the real interest rate basis, I will be lagging behind.
Right. So again, as I said in the beginning, every investment depends upon the risk appetite of the person, of his portfolio overall allocation. So this obviously, in real interest rate, real return phenomena, this is not as good as compared to a AAA credit investment. Sorry, AA credit investment. But again, let's say if you have got 100 rupees to invest across multiple bonds, so at least 30-40 rupees should be invested across these options. 30-40 rupees should be invested across what you call is 1 to 1.5 year AA credits, which you're getting at, let's say, 12%, 13% kind of return. Even if there is some mark to market, again, mark to market concept is not applicable if there is an HTM. If you have got the visibility on a liquidity of the portfolio, then obviously when you invest 10 lakhs into a let's say 1-year bond of AA trading at 12%, you are getting at post tax of, let's say, 9%. So my sense is that 30 to 40% should be invested across these target ETF bonds. The remaining 50 to 60% can be spread across 3 or 4 AA names, which are pretty good names, but because of market, let's say, mispricing, or because of lack of demand and supply, the yields are trading wherever they are. So there are many NBFCs, I don't want to name anyone, but which are double A rated, and their bonds are trading at, let's say, 10%, 11%, or 12% for that matter. So there one should look to actively invest, because you will get good rates in these environments, and these rates need to be locked in for at least next 1 year, 18 months.
Great. So I got fully the idea, because so the portfolio mix you are suggesting from the bonds perspective is like 30-40% should be in the target ETF bonds. So there you have a security, the capital is secure, and you can't beat the inflation, but at least your capital protection is there, and you earn some say 7 to 8%, which is comes to post around 5%. And for a kicker, when you
Yes.
want to beat the inflation, you could look at the smaller tenor bonds, which is 1 to 2 years for a good credits, and these are priced between 9 to 12% because of various reasons, because of supply and demand issues, because of the arbitrage and the credit spreads. Have I understood correctly, Satya?
Correct, correct. You have got it completely right.
Great, great.
So the blended portfolio yield. So let's say you're an investor, and let's say out of your total 100 rupees of investment, you are putting, let's say, 60 rupees in debt. So in that 60 rupees, let's say 15 rupees, 20 rupees should be towards this target ETFs, and the remaining 40 rupees should be in double A bonds.
Mhm.
Obviously, in times of risk aversion, your allocation towards debt should increase significantly as a part of overall portfolio. So like, let's say earlier 1 year back, if equity was, let's say, 70 and debt was 30, now equity should dial down to 30, and equity should go up to 70, because there is a huge amount of uncertainty in terms of valuations, in terms of flows in equity. So for me, I mean, I think we have yet not seen the bottom. So better to be in fixed income returns. They are boring, but they are pretty consistent. And if you're able to manage that portfolio, blended portfolio of around 8%, 9%, you would basically be able to at least not only save your principal, but at least manage to beat the, let's say, the CPI.
Great. So, I think at least both of us are in agreement that since there is a rate hike cycle going to continue, and the first thing which are impacted is the riskier asset class. We have seen what has happened in crypto, which is altogether a different topic to talk. And we have seen the equity markets there's some more pain expected in the market. So, in times of turbulent times, one should look at realign its portfolio allocation to between the equities and bonds. And for the bonds also, one should put say if it's putting 70%, the percentage may be different from person to person depending on the risk appetite. Out of those 70%, one could look at 30-40% onto the ETF bonds, which are secure and give a capital protection. For another, they can look at a smaller paper, good credit. So so this is all we have from the slide. So I think there are a lot of people who ask a question. So one is coming from Dipesh. So he's saying, since there is going to be a rate hike cycle, how comfortable are you with credit exposure? Because so what he's saying is when the interest rates goes high, there is a probability of default in the paper below A or below increasing.
Right. Right. So my sense is that first of all, I believe this is going to be a shallow rate hike cycle in case of India. So we might move from 4.90 to, let's say, max 5.75 by December 2022. I do not recommend going below double A in terms of credit ratings. And again, the specific investor has to do a decent amount of research on what kind of papers they are going to invest. So for me, yes, theoretically, in interest rate hike cycle, lower rated papers might feel some stress, but I feel that the kind of credit growth which is happening around 11% year on year, and the government has asked all the banks to, let's say, maximize the credit flow towards all the parts of the economies. I don't see this rate hike cycle creating any kind of credit stress, because right now, if you look at whether it is NPS of banks, whether you look at credit card servicing from all the retail side also, all the NPS are pretty well managed. So you're not able to see the stress in any part of the curve. And also, I'm still maintaining that let's not go below this double A part. You would still get 12% papers in double A part of the curve. You don't need to go to A part of the curve.
Great, great. So we'll request our participants to type in the question in the Q&A section.
So Shaunak has seen this question that which category of debt mutual funds should one
Should
look
one
at?
look at? Yes, I
Yeah,
missed that one. Time frame approx 1 to 2 years.
2 years. So Shaunak, hi Shaunak. My sense is that we should be looking at short-term income funds. Let's say if you have a allocation of let's say 100 rupees to be invested in debt mutual funds over the period of next 6 months, start doing periodical allocation of 25 rupees each every 2 months. So in the next 2 months, you invest 25 rupees in the short-term income fund. After 4 months, you again invest the next 25 rupees, and that way you complete the 100 rupees in next 6 months to 8 months. So that way you'll be able to at least time the your NAV entry into the debt mutual fund. And short-term income funds, I think, are in a very sweet spot right now. Just on a blended basis, let's say if the 1 year CD is trading at 6.25%, and let's say the 3 year NABARD is trading at 7%. So the blended yield comes around somewhere around 6.757%. And if this yield goes up, let's say you'll be able to capture the entire movement in the yield from 7% to 8% types of numbers. So post tax will be making at least 6% kind of number, which is pretty decent return. So that's what I would advise you.
So Satyakam, I think the problem with debt is, which I feel is the government. The taxes eat into whatever earnings you make, and at that time, if you see long-term capital gain, for bonds it is more than 3 years, then only you have 40% taxation. However, in case of equities, it is if you are holding for more than 12 months, you have 10% capital gain. So government itself is incentivizing, and which is a big factor, because we have to look at post-tax return. So isn't that happening? So how does one have a blend of both of them?
So there has been media reports around 2 months back that there has been some discussion inside the financial finance ministry that both these equity and debt taxation needs to be brought to the same level. Right now, there is a different treatment to equity and debt, which do not make sense. If you really want to incentivize long-term capital formation inside your country, and you want to, let's say, flow the domestic resources, domestic savings into debt, then obviously you need to treat them at par. You can't be treating one asset at differently than the other asset. So I think it's a matter of time. I think most likely by next budget or so, you would see some changes in the taxation policy. I mean, we are talking about creating 1 lakh crores of national monetization pipeline and all those things. But where do you get the capital from? I mean, the best source of capital is your domestic savings, but you can't incentivize your domestic savings without bringing the taxation structure of debt investments on par with equity investments, right? So it's a matter of time before it happens. But yes, we have to accept the reality right now.
So there are a couple of more questions.
Yeah.
From Venkata Gandhi. So he's asking, since the yields are going to rise, isn't it prudent to invest in cash generating equities like blue chip, TCS, or IT? He said IT.
Yeah.
Maybe Infosys he meant.
Yeah. So nothing against equities as such, but my sense is that first of all, this is there's going to be a global slowdown in 2023 onwards. Okay, because when you see such a kind of series of rate hikes in US around 3.25%, 3.5%, automatically you would see a lower amount of spending from US corporates on IT services. So I mean, there have been recent reports from JP Morgan, Citi, and everybody else that they are trying to, let's say, lower the EPS estimates for IT, etc. So, I mean, from a cash generating perspective, dividend perspective, yes, these companies make sense. But on the overall market, I am feeling not comfortable. So, my sense is that I would try to reduce my allocation to equities to bare minimum right now, and try to move towards debt right now. I mean, we are still not entered the times of when equity looks cheap, right? So we are still far away from that.
Great. Another question is from Dipesh. He's saying, since RBI may not have the luxury to increase rates in line with Fed, so the interest rate differential between US and India, would that put significant pressure on the USD INR exchange rate?
Right. So this is a very intelligent question. I think people do not talk about FX right now in our country. We talk about equity. We talk about equity too much. Then we talk about debt a little bit, and FX we completely forget. So right now, if we are going to see this interest rate differential between India and US reducing so much, automatically it is going to lead to pressure on FX. And my sense is that we are headed towards 80 sooner or later. I mean, the central bank has been trying to reduce the volatility in the entire depreciation of rupee. But my sense is that RBI should not come at every level to defend the rupee. There are certain levels which needs to be defended technically. But beyond that, I mean, if you look at the rupee behavior in the last 1 month, it has been range bound between 77.5 to 77.8. This is not natural behavior. I mean, when Brent is going to 124, 10-year US is going to 3.15, you can't have your domestic FX behaving in such a low volatility environment. So my sense is that you will see USD INR getting depreciated, but it is positive for debt investors. Why, I will tell you. If USD INR depreciates too much, let's say moves towards 78.5, 79, then RBI has a window to go and, let's say, support INR. When they support INR, they buy INR, so they suck out liquidity, and then they can justify the OMOs in debt markets, and the yields might come down. So a key thing to watch for debt market participants in terms of where the yields will stop is perhaps FX. If FX crosses 78.5, 79, and RBI comes to save it, then automatically you might also see OMOs happening in the debt markets as
well. Another question is from Shinu. So I think she must have seen on our website product. There's a recently listed product of Navin Jindal Group, which is MLD. So she wants to know what type of instrument is it? Is it debt or equity? So I think she wants to know the taxation, how it works.
Vikas, you can put some light on that.
Yeah, so I'll take this question.
Yeah.
So, Shinu, as we talked about just a couple of questions back, in a debt, you have to pay the tax on the interest, which is as per the marginal tax rate of the investor, which means if someone falls in the 30% bracket or 42% bracket, he has to pay that much tax on a normal bond. In a case of equity, you have to pay whatever tax bracket you are, you have to pay long-term capital gain tax of 10% if you hold the paper for more than 12 months. So because of this anomaly, which Satyakam told is there's a bit discussion in the corridors of government, it might be bridged in near future. But what the finance people have done smartly, they have brought a hybrid product, which is necessarily a debenture, but it has some equity-like characteristics. So what they have smartly done, they put a condition. They link the return of the bond. Return means interest rate of the bond or coupon of the bond to a market event. And that market event is almost not going to, is very unrealistic to say. Say, just to give you an example, I say there is a bond. I'll give you the same example. I'll just put a Navin Jindal Group for example for ease sake. Say Navin Jindal Group has come up with a MLD, market link debenture, which is nothing but an NCD. He says, this is just an illustration, not the actual. Say, if the population of India remains above 20 crores, I will give you 10%. And if the population of India goes below 20%, 20 crores and stays above 5 crores, I will give you 9.75. And if it grows below 5 crores, I will not give you anything in coupon. So what he has smartly done is he has created an uncertainty in the eyes of income tax department. So it is treated as a hybrid product and taxed at equity level. So we all know that the population of India is not going to fall below 20 crores. So we are already around 130 plus crores. So in 2 years time, the investor is going to get a return of 10%, which is cumulative. So which comes around to 1.22x, and the taxation on that would be 10%. So these products are listed on the market, and one can sell them after 13 months and can get a capital gains tax, which is taxed at 10% rather than 30%. So this is the financial engineering that has been done by the finance people, and this is the bond that you might have seen on our platform, and it is very popular in the HNI market, and you see these coming very often and being issued by many players. Does that answer your question, Shinu? Yeah, thank you. If anyone has any further questions, please ask. We have around 5 minutes more. So in the meanwhile, so what is the next event that one should look at, Satyakam? Like, what would be the next trigger?
So broadly, what I'm looking at is FOMC meeting on Wednesday night. My sense is that Mr. Powell will come with the attitude of whatever it takes. I'm expecting a 75 bips hike on the Wednesday night FOMC meeting, and plus subsequent guidance of 50 bips hike in June as well as sorry in July as well as September meeting. So, and if he tries to, and again tries to make it look circumspect or again tries to sugarcoat the requirements of the time, then the bond yields might again get unhinged. So you might see a decent amount of 10-year US movement yields, 2-year US movement yields in this week itself. And one of the things which you need to watch out is the 2-year US yield. Everybody talks about 10-year, but 2-year is far more critical. Why it is critical is because it determines the amount of FPI flows towards emerging markets. So just to give you an example, let's say if the 2-year USD is at let's say 3.05%, my 1-year hedging cost is let's say 3.75. So I have to at least expect to make 6.80% on my equity investment. Is that looking like a possibility in Indian context right now? I don't think so, and not in only in Indian context, but many emerging markets. So it is a given that FPI outflows are likely to continue. It might only accelerate. So from October till now, we have seen around 30 billion odd dollars going out. $30 billion is a huge amount. In subprime 2008, when that much amount of money went out, Nifty has corrected by 50%. Right now, it is because of the retail and the domestic institutions we are saved. But sooner or later, this trend might not sustain. And I think this also leads to a certain amount of macroeconomic risk. I mean, the kind of low deposit rates are there, which are there right now, are incentivizing people towards riskier assets, and maybe they are not able to price it well. I mean, we might look at this in terms of financialization of savings, but I think 2 years, 3 years down the line, it might come to bite back. I mean, excess of anything is not correct. I mean, if you look at FPI investments in listed NSE space, it was around 21% 2 years back. Now it is hardly 18.5%. If you look at retail participation, retail was holding 7% of listed. Now it has gone to 9% plus. So in such a small period of time, if the retail is gaining at the cost of FPIs, how long will it contain? How healthy it is? That's a big question mark. So next week is very difficult. I mean, eventful. 16th of June. After that, we have the RBI policy somewhere in August, 8th of August. Also, the CPI reading of India is due on Monday. I'm expecting 7.1% for the month of May. Again, for the month of June, I'm expecting 7.20. And July and August number, I'm expecting 7.758% kind of number. One of the
So,
things which, yeah.
So sorry, so I'll just take a question, Mansi, because it's related to the same thing.
Yeah.
You said FPI would be, you can expect FPI outflows to happen from the equity market. So she has asked a very smart question. Since the yields are going to increase, wouldn't that have a FPI inflows into debt market?
Okay. So one thing we have to understand is that how does FPIs function? Okay. Now FPIs have a what you call is first of all geographical allocation. And in that geographical allocation, they have asset allocation. Right now, if you look at FPI holdings in Indian debt markets, it's very, very low. I mean, regulator allows 6%. We are hardly at 4%, 4.5%. When you see in terms of real yields, in case of India, right, let's say 10-year GSEC is at 7.5%, and my CPI is 7.79. So my real interest rate is again zero. I'm not offering anything positively real here. So I don't see much amount of debt inflows coming into India. Also, not only because of all these factors, but also because our fiscal deficit is pretty much screwed. So, and considering whatever has been happening in terms of our, government giving the cutting the taxes, excise duties, etc., increasing the food subsidy till September, and increasing the fertilizer subsidy. So all these are going to lead to additional borrowing somewhere of around 1 to 1.25 lakh crores. That's my idea. That's my guess. That's my estimation. All these factors will lead to uptick in yields. And FPI does not come into any country for that matter unless and until they see a positive real rate. Okay, and with considering the amount of hedging cost, considering the amount of there are so many options available for them to go elsewhere. I mean, they can easily go into China as well for that matter. Okay. So I don't see much FPI flows coming into India in debt, even if the yield rises.
Okay, and I think there's a question from Om Vajaria. So he's saying on the one hand, MPC is increasing the repo rates and tightening the liquidity, and on the another side, they are raising the lending limit for cooperative banks. Does it sound contradictory?
I think I might not be the best person to comment on the cooperative bank policy, but the idea is that I mean, my sense is that whatever I'm reading and hearing is that uh, the regulator wants the banking system to be stronger than the shadow banking system, and that's why you're seeing all these kind of changes in the regulatory requirements for shadow banks and the let's say the lending changes happening for the cooperative banks. So these two can't be correlated. First of all, these are two different topics. One is monetary, the other is what you call is
Social inclusion, I would say. The
yeah,
more
yeah,
of inclusive policy. They want
yes,
to
yes,
propagate
yes,
the reach of the common
yes,
people to borrow. I think
yes,
that's
yes,
so these are two different
yes.
things.
You can't link them.
You can't link them. Venkat Grandi, I'm sorry, I will not be able to give you the suggestion on how to handle your stocks and RSUs. So that you will have to talk to your wealth advisor or a tax consultant. So sorry, we cannot take it here. So there's another question, Satyakam, from Ashish Jalan. He's asking, what are your views on the Indian bond market, Indian bonds getting listed on the EM bond index? What, according to you, will be the terminal repo rate? I think you answered that, but happy to hear you again.
So my sense is that the addition to emerging market bond index is stuck at the taxation policy. The bigger issue there is that the global clearing houses, they don't want any taxation in terms of capital gains, because that's what the global policy is right now. But we have a policy of capital gains tax. So then there is a discrimination between the domestic investor and the global investor, and that's where things are stuck. I don't see it happening right now because the first step is the government okaying it. The second step is the clearing houses okaying it. The third step is all these index manufacturers, whether it is Barclays, whether it is Bloomberg or FT, they have to then analyze it, add it to their index, and then after 6 months the flows start. So my sense is that we are not going to see anything on that by the end of FY23. There might be some kind of movement by March 2023 in the next budget, but let's see. But don't see it happening in this fiscal. Second point is terminal repo rate. I think 5.75 to 6 is what I'm looking at right now. Let's say till March 2023. After that, let's take a call. It's too long time after that. So 6% is what I'm looking at right now. 5.75 to 6%.
Okay, so we'll take the last question for the day, which is from Mansi, and she's asking, where do you see system liquidity at the end of this financial year? So there was a slide on that.
So right now our system liquidity is 3.1 lakh crores. Okay. And if you add the government cash balances around 3 lakh crores, so the core is around 6.5. If we move ahead in time period, the remaining 9 months in this fiscal year, you would see certain amount of CIC leakages. You would see a decent amount of balance of payment deficit. You would see a certain amount of FPI flows. So my sense is that even if RBI goes for no change in CRR by end of FY23, we should be around 1.5 lakh crores or 1.75 lakh crores in terms of system liquidity. That is almost only 1x of NDTL. That's my sense.
Okay. So I think we won't be taking any more questions. And thanks, Satyakam. And it has been a really insightful session. And it's always a pleasure to talk to you and learn from you. And I hope it was equally insightful for our audiences as well. So look forward to you for many other sessions and
Yes.
get back to you.
Thanks, Vikas, and take care and get well soon. And hope to see all of you in the participants sometime soon next month. Thank you. Bye bye.